Is the UK property market finally crashing? Because if you've opened a news app, scrolled social media, or spoken to an estate agent lately, you'd be forgiven for thinking the whole thing is about to fall apart. House prices falling, mortgage rates surging, buyers disappearing, the end of the property boom. Some are calling it a collapse. Others say this is 2008 all over again. And a growing number of people are sitting on the sidelines, frozen, waiting for the moment everything finally breaks. But here at UK Money Guide, we don't do panic, and we definitely don't do clickbait. We do data, context, and reality. Today is February 5th, 2026, and what's actually happening in the UK property market right now is far more complicated and far more interesting than the headlines want you to believe. This is not a simple story of prices up or prices down. It's a story of pressure, resilience, and major shifts happening quietly beneath the surface. Whether you're a first-time buyer hoping for that long-awaited dip, a homeowner nervously checking your Zoopla estimate, or a landlord wondering if the numbers still stack up, this video matters. Because the decisions you make this year could shape your finances for the next decade. In this video, we're breaking down the latest 2026 data, the Bank of England's most recent moves, and why the crash everyone has been predicting for years might not arrive with a bang, but with a slow, uneven grind that catches people off guard. We'll look at why some parts of the country are seeing genuine price falls while others remain stubbornly strong. Why demand hasn't vanished, it's just changed. And why affordability, not fear, is now the single biggest force shaping the market. Most importantly, we'll answer the question everyone is really asking: what does this mean for you right now? Should you wait? Should you buy? Should you sell? Or should you be doing absolutely nothing while everyone else panics? So, before you make a move based on scary headlines or bold predictions, let's slow this down, cut through the noise, and look at what the numbers are actually telling us about the UK property market in 2026. Let's look at the numbers first, because this is where the panic narrative starts to fall apart. According to the latest ONS and nationwide data, we are not seeing a vertical drop. There's no freefall, no sudden cliff edge. What we're seeing instead is something far less dramatic, but far more realistic: a measured recovery. Yes, late 2025 was shaky. Prices wobbled, transaction volumes dipped, and uncertainty around fiscal policy caused a lot of buyers and sellers to hit pause. But as we've moved into early 2026, something important has happened. That fear has started to fade. In fact, new seller asking prices are up by around 2% compared to the end of last year. And that surprises a lot of people. Why would prices rise when everyone's talking about a crash? The answer is simple: pent-up demand. Thousands of people who delayed decisions in 2024 and 2025 are finally re-entering the market. And they're doing it cautiously, but confidently. However, and this is a big however, the UK is no longer behaving like one single housing market. The days of one headline telling the whole story are over. What we're seeing now is a clear tale of two countries. In London and much of the South, prices are flat at best and edging down in some areas. Not because demand has disappeared, but because the entry bar is brutally high. Higher mortgage costs, tighter affordability checks, and stretched household finances mean buyers simply can't chase prices any further. The ceiling has been hit. But shift your focus north, to the north of England, Scotland, and Wales, and the picture changes dramatically. Here, we're still seeing price growth and stronger transaction activity. Why? Because affordability still exists. When the average home costs £200,000 in Manchester or Leeds versus £600,000 in London, buyers have room to breathe, even with higher interest rates. And this is the uncomfortable truth many headlines avoid. Property crashes don't happen everywhere at once. They happen where prices ran far ahead of wages and fundamentals. In other words, pressure shows up first where the bubble was thinnest. So, what looks like chaos from a distance is actually the market doing what it's always done, rebalancing. Pain in some areas, resilience in others, and opportunity hiding where few people are looking. You can't talk about the property market without talking about the Bank of England, whether people like it or not. The base rate has been the single biggest driver behind this so-called cooling we've seen over the last couple of years. Right now, average mortgage rates are hovering between 4.5% and 4.9%. And if you rewind just a few years, when people were locking in fixes at close to 1%, that jump feels like a total shock to the system. Monthly payments haven't just risen. For many households, they've fundamentally changed what's affordable. But here's where the story gets more nuanced. On the good news side, lenders are clearly hungry again. Competition is creeping back in. We're seeing quiet price wars behind the scenes, with banks shaving 0.1% here, 0.15% there, offering cashback, 5 free deals, and slightly more flexible criteria, all in an effort to win business in a slower market. That tells us something important. Lenders are preparing for volume to return. Now for the bad news, and this is the reality check. The era of cheap money is officially over. Ultra-low rates were an anomaly, not the norm. And that means the psychology of the market has changed. Buyers are no longer panic bidding. Estate agents aren't phoning people saying, "You need to offer today or you'll lose it." Those days are gone. As a result, the behavior on both sides has shifted. Buyers are running the numbers properly. They're negotiating harder. They're walking away more often. And sellers, whether they like it or not, are being forced to price realistically or sit on the market. This is why what we're seeing doesn't look like a crash. There's no fire sale, no mass dumping of property. What we're witnessing instead is a transfer of negotiating power away from sellers who benefited from years of cheap credit, and toward buyers who now have time, leverage, and options. We also have to talk about what I call the budget hangover. Remember that frantic rush at the end of 2025? Chains forming overnight, offers flying in, solicitors swamped. That wasn't confidence. That was deadline psychology. People were scrambling to beat potential stamp duty changes, pulling demand forward from 2026 into the final months of last year. Now fast forward to February 2026 and the sugar rush has worn off. That artificial surge has faded, and what we're left with is the real market underneath. Right now, we're seeing a huge amount of stock sitting on the market, in some regions at the highest levels in a decade. And basic economics kicks in. When supply rises sharply while buyer demand is held back by higher interest rates, prices don't crash overnight. They soften, listings take longer to sell, and reductions become more common. This is where the headlines start shouting collapse, but this is also where context matters most. Here's the key reason a total crash remains unlikely: the housing shortage. The UK still isn't building enough homes, not even close. New supply continues to lag population growth, household formation, and long-term demand. And that imbalance creates something incredibly important in the market: a price floor. Unlike 2008, we're not dealing with mass over-leveraging, loose lending, or forced selling on a national scale. Most homeowners today are on fixed rates, stress-tested at higher levels, and sitting on significant equity. That means fewer people are forced to sell into a falling market, which is exactly what turned a slowdown into a crash back then. So while we may see 5 to 10% corrections in certain overheated pockets, the idea of prices falling 20 or 30% across the board runs straight into a structural wall. Too many people, not enough homes. In other words, this isn't a market collapsing under its own weight. It's a market digesting excess slowly and unevenly, while a chronic housing shortage quietly props it up from below. So, is it actually a good time to buy? The honest answer is, it depends who you are. Because 2026 is rewarding realism, not speculation. 1. First-time buyers. For the first time in years, you genuinely have leverage. 2 years ago, you were competing in sealed bids, waiving surveys, and stretching yourself just to be considered. That pressure has eased. There's more choice, fewer panic buyers, and sellers are far more open to sensible negotiations. If you can comfortably afford the monthly payment and you're planning to stay put for several years, trying to perfectly time the bottom is usually a mistake. Time in the market still beats timing the market, especially when rents remain high and rising. 2. Sellers. The market is no longer rewarding optimism. It's rewarding accuracy. If your property has been sitting on the market for 3 months with little or no serious interest, that's not bad luck, it's feedback. Buyers in 2026 are informed, cautious, and price-sensitive. The sellers who succeed are the ones who move first, adjust early, and attract fresh attention, not the ones who chase the market down with a series of small, reluctant reductions. 3. Investors. This is where the shift is most obvious. The old playbook of buying trophy properties in the Southeast for capital growth alone isn't working right now. Higher rates, higher taxes, and tighter regulation have squeezed yields hard. Instead, the numbers are increasingly pointing north, where entry prices are lower. Rental demand remains strong, and yields still make sense even at today's mortgage rates. In 2026, boring cash flow is beating flashy postcodes. The common thread here is simple. This market isn't broken, it's disciplined. And for buyers and investors willing to do the maths, negotiate properly, and think long-term, that discipline can actually work in your favor. In summary, the UK property market isn't crashing, it's recalibrating. We're moving away from an extreme seller's market driven by cheap money and fear of missing out, and towards something far healthier, a fair market, one where prices are anchored to reality, negotiations are normal again, and decisions are driven by affordability, not panic. That kind of shift can feel uncomfortable. It creates scary headlines, but it also creates opportunity for people who stay informed and keep a long-term view. If you found this update helpful, please hit that subscribe button for UK Money Guide. We do these deep dives every week so you're not reacting to noise. You're making smart, confident decisions with your pounds. And I'd love to hear from you. Drop a comment below. Are you seeing prices fall in your local area? Or is it still a bidding war where you live? I read the comments, I reply to as many as I can, and the best insights often shape future videos. Thanks for watching, stay grounded, stay patient, and I'll see you in the next one.